You want to become smarter than 98% of your friends and show off that finance lingo? I got you. What's going on, people, and welcome back. Nice to see your beautiful faces, and today I want to show you the 10 most important finance terms to know to boost your financial literacy. And if you already know about the term I'm talking about, feel free to jump to the next chapter in the video following the time steps in the description below. So if I were to start a baking company, now for the record, I can't bake for life, but for the sake of example, let's call my company Shake and Bake.
Shake and bake!
Now don't judge me on the name.
Makes no sense, so it's shake and bake, it's nonsense.
So in order for you to be able to buy shares of Shake and Bake, my company would have to become a publicly traded company, which means it gets listed on the stock market and is available to invest into for people like you and me, and even George Clooney. Or if you own a pension plan or you own some mutual funds through your place of work, it generally means that you're already invested in some publicly traded companies. So in order for me to get Shake and Bake listed on the stock exchange, I would have to hold an IPO, initial public offering, meaning that my private company is now mature enough and it meets certain criteria to offer shares to general public. Consider an IPO to be an official welcome to the stock market and a chance for investors to get some shares at a discount. Now that Shake and Bake is a publicly traded company, it needs a ticker symbol, which is like a nickname. It's like a tag that it's known by on the stock market. Ticker symbols are abbreviation of the name and typically kept pretty short, somewhere between 1 and 4 letters. For example, the name the Bank of America Corporation, that name is way too long, so its ticker symbol is BAC. It's nice and short and it's easy to find. So let's say the ticker symbol for my company, Shake and Bake, is gonna be SAB. Now Shake and Bake, or SAB, is listed on the stock market and is able to make you its shareholder, which is described as a person or an entity that owns at least one share of that stock. A shareholder is essentially a part owner of the company. If you own more than 50% of the shares of the stock, that makes you a majority shareholders, and in many cases it's the company founders. And if you own less than 50% of the stock, that makes you a minority shareholder. No need to be offended, because all shareholders can benefit from the company's success, but also their profits can tank if the stock price goes down too much. The stock price is exactly what it sounds, the price that the stock is being sold and bought for at that moment. And if you go to Yahoo Finance app and pull up your watch list, by clicking on the ticker symbol, you get this big number at the top, and that's the stock price. It's always changing, but it's a great way to monitor the price movement. And the next most important thing to check is the market cap, also known as market capitalization. It's an easy way to tell the size of the company and its worth. It's calculated by taking the number of outstanding shares and multiplying it by the current price of the stock. If we bring back Shake and Bake as an example, we know the company has 1,000 shares outstanding, traded for $10 each. That means that SAB's market cap is 10,000. But generally, you don't need to do the math. You just go back on the app, you click on the ticker symbol, you scroll down, and then you look right above the middle. It says market cap, and the numbers are typically shown in millions or billions. By the way, this area of the app is gold. It tells you many important qualities of the company. For example, I always look at 2 metrics. First one being the dividend. A dividend is when a portion of earnings gets distributed to its shareholders, like a little bonus. Now consider Shake and Bake giving out a gift in a form of allowance to its shareholders. Now that's called a dividend. Not every company does that, but you would understand why investing in dividend companies would be more attractive. A dividend is typically given out quarterly, which means every 3 months or sometimes once a year. And to see if the company gives out a dividend, you're gonna check this second last line, and you're gonna see 2 numbers. The first number is a dollar amount, and that number changes depending if the price of the stock goes up and down. Now the second number is in a form of percentage, and that number changes if the company decides to change it. Now the second metric that I love to check is right here, and it's the PE ratio. PE ratio is relating company's share price to its earnings per share. And if I see a high PE ratio of, let's say, 20 and up, that typically means that the stock price is either overvalued or the company is expecting big growth in the future. A very comfortable and safe price per earnings ratio would be somewhere between 12 and 18. That's my comfy spot. And once you checked out the company's metrics and you're like, yeah, I like it, everything looks good, and you buy some shares, you're now the shareholder of the company, and now that also means you're not well diversified. You must have heard that word before, and it means not putting all of your eggs in one basket. Ooh, hold on. Yeah, don't do this. And not only because it looks stupid, but because if you have all of your money, or in this case eggs, in one company, and that company crashes, you're gonna lose all your money. But if you diversify and you split your investment into separate companies, therefore putting your eggs in different baskets, and if that one company goes down, you'll be able to rely on other companies in your portfolio to bring your investment back up. I like to be diversified in different sectors as well, following different indexes. An index is a method to track the performance of a certain collection of companies. If you look at the top of the page at Yahoo Finance, you're gonna see TSX, S&P 500, Dow Jones, NASDAQ, etc. They all represent the performance of a bundle of companies that are grouped together either based on the market cap, the sector, or the general market. So the next time you're gonna hear on TV that the Dow Jones fell 40 points, at least this time you're gonna have some idea what they're talking about. And the last and final term, and that's the most popular way to invest by, is dollar cost averaging, which means to put a certain amount of money into your investment over regular space intervals. Basically to average out your cost, hence dollar cost averaging. As an example, I decide to invest $100 into my company Shake and Bake on the first of every month, regardless of the market's condition. Kind of like buy it and leave it approach. Considering that over time, my investment will compound, and it's the amount of time I leave my money in the market that will multiply my original investment. You are now literally more knowledgeable than 98% of people who don't know this, so congratulations. Let me know in the comments section which other finance terms should join the basic 10. And if you enjoyed this video, make sure to smash the like button and subscribe for more. And I'll see you in the next one.